Good morning, everyone, and welcome to our 11th Ag Economic Dialogues. I have 10 o'clock now, so I think we'll get started and try to keep on schedule a little bit here. This month, we're going to be covering prevent plant considerations that you might need to be aware of, and some of the revisions back to what we're supposed to be living with prevent plant considerations. We've also invited two of our Sdsu Ness School of Management and Economics professors to talk to us today. They're going to cover some more of the general economic situation that we're all living in right now. And then we're going to wrap up with the grain marketing tool that Drs. Matt Elliott and Lisa Elliott have created and have made available online for everybody. So, as always, we invite questions as we go through. You can either do that through the chat box by hitting the little chat icon at the bottom of your screen and typing your questions in, and then we'll get them asked for you. Or at the end of the presentation, if you would like to unmute your microphones and ask a question directly that way, we can make that happen as well. Just as housekeeping note, I have everybody muted to start with to keep the background noise and all that type of stuff kind of at a limited basis. So I think with that, we're going to turn it over to Jack Davis. He's going to give our first presentation today, so I will turn the controls over to him.
Okay, did the slideshow come up for you guys?
Yes, you need to hit the slideshow part of it, but we're starting to see it.
All right. Slideshow from beginning. There we go.
Perfect.
There it is.
Okay. Jack Davis, I'm the Crops Business Management Field Specialist, normally out of the Mitchell office. And I guess that's still the home location. And of course, we're all working remotely now through the COVID crisis and social distancing. So you can still call there, leave voicemail. Those come through to us into our computer, and we can pick those up. And also at the contacts, I can give my cell phone out too. So you sure can get a hold of us, and or through email. That's always a good way also. Yeah, we're going to look at some prevent plant issues, and just probably to start with here, look at our 30-day forecast that came out yesterday from the Climate Prediction Center. And on the left side of your screen is our temperature outlook, which is the EC stands for equal chance of being the normal, above normal, or below normal. So just going to kind of be a normal May, which is probably better than we were last year going in. We're not near as cold temperature wise as what we were last year. And over to the right then is a precip outlook, which may provide us only short windows to get planting done according to that, but we'll see how that plays out as we move through May. Sounds like next week's going to be pretty good for much of the state. Maybe some small grains will get started, and maybe some of the field work. So here we're looking at a crop progress report in the top 18 corn states. And this chart is looking at the acreage with surplus top moisture, the percentage of acres that have surplus top moisture in those 18 states. And the dark line is 2019, and the red is 2020. And then those are the weeks going across the bottom there. So we're just into week 15 of the year. And if we keep going, that surplus moisture is moving away across most of these states. So that probably bodes for good corn planting conditions, even though the economics aren't good on corn. The weather conditions and the soil conditions are probably better than they were last year at this point. Here, looking back just at South Dakota, those dark green counties were the highest rainfall on record in 2019. That is a lot of the state. So with that being said, and just driving through our area, there will be probably some prevent plant acres coming up in 2019, just because there's too much water standing around. And if we get untimely rains, there'll be some areas that won't get all planted that they would like to. And the 19 was a crazy year, as you all know, as far as rainfall. Not only were they the highest on record, but a lot of them were double of what normally those areas would receive. So now looking at that same chart, except for just South Dakota with a surplus topsoil moisture. And we are below what we were last year, and our trend is kind of going to show us, at least through April, probably down a little bit, and some drying with some nice warm weather coming over the weekend and into next week. But we'll see how our May forecast plays out and how that ends up. We're still wet, as I said, from carryover from last year in that center part of the state for sure. So here's just a reminder of our final plant dates. This is a map from RMA. They have 18 on it, but we just did, the date is the same and just changed the year. So spring wheat in the north is coming up on May 15th as the final plant date, and spring wheat in the southern part of the state is May 5th. And we'll talk about final plant date and late plant date coming up. Here's corn final plant dates. Majority of the state is the 25th of May, and the southeast has another week and goes to the 31st. As you can see in those pinkish or orange type colored counties. Soybeans then, for all of the state that has soybean coverage, it's the 10th. So June 10th is the final plant date. Okay, so now we'll talk options for prevent plant coverage under their common crop insurance policy. You have a final plant date, but then there's a late planting period, and that goes from 25 days after the final plant date. So we back up and just use soybeans. So our final plant date is June 10th. We have 25 days that we can use to plant into the late plant period if producers choose to do so. And during that time, the crop insurance coverage or their guarantee goes down by 1% each day past the final plant date. And then they have 25 days and then it's done. Their other options, say if they can just choose to plant a different crop, and you would just plant that crop and then pay the crop insurance on that. So say if you intended initially to do spring wheat, ended up too wet, and you finally moved that to soybeans, you would just go ahead and plant the soybeans, and that would be your coverage then would be for soybeans. So that's an option. And then also then if it just stays too wet and they do not want to plant or choose not to plant into the late plant period, they can take the full prevent plant on those acres that they have eligible for those crops. There's just an example of what a prevent plant payment would look like. I just used 150 APH, which is actual production history over time, a 10-year production history. 388 was our corn projected price, and I used a 75% coverage level. So with that in place, we'd have about a $440 revenue guarantee. If they took full prevent plant, that is at 55% for corn. Now, some producers were able to buy up. You could buy up 5% on prevent plant, and some may have done that so that it would be 60%. So that was an option that was available for those that got that at sales closing date, which was March 15th. And just using a soybean example, using 45 bushel yield, APH yield, and 917 was our projected price from RMA, and the 75% giving 309 revenue guarantee. Soybeans is a 60%, and there's also available a 5% buy up, so some may have a buy up of up to 65. So we're looking at the 60% at 185 for soybeans and back to our corn at 240 if they end up taking a full prevent plant. Now, this is the change that people may not be aware of or may not want to be aware of, but we go back to the 2018 rules. And we cannot hay, graze, cut for silage, haylage, baleage until after November 1st. In 2019, with the nationwide spread of prevent plant, that was changed to September 1st. And it could be harvested after September 1st. That is not eligible as of now for 2020. And I would not look for that to come about. Senator Thune had introduced a bill to change it to 90 days after the final plant date nationwide, but that was on March 12th when that bill got introduced and was in committee. So I'm suppose nothing has happened to it since then. Just going to quick introduce how our stock market has fallen and oil prices. So in the blue is the S&P 500 index, and that's gone down 15% from January 1st to April 12th. In oil, I used cash spot West Texas intermediate crude price for this, and that's down 66%. We'll go to the grains. So the blue is the S&P, which I didn't have labeled here. Sorry about that. But we'll start at the bottom, and that is corn. Corn is down 24%. The S&P is 15%. Soybeans are down around 10, 9.8 here. The wheats have not gone down a lot. So spring wheat down about 3.2, and winter wheat just less than 1%. And that's what I have for today. Are we taking questions now or at the end, Heather?
We can take some questions now. If anybody has any, they can either type them in, or if you want to hit the unmute button. Okay, so Jack has his contact information up there. And there are questions that just came in. To answer the first question, yes, the slides will be shared once we get them all processed so that they have the closed caption and everything like that. They will be available. I will be emailing them all directly to you once we get that done. And then they're also on the Sdsu Extension YouTube channel. Jack, one question came in that said, do you have many farmers switching corn acres to bean acres? Do you see that happening?
I don't know that we are yet. Well, I haven't talked with the suppliers so much. I was talking with them earlier before everything blew apart. So at that point, they were not. But now we may see that, especially in South Dakota, because of our price difference and the price fall, and just planting conditions. I could also see some more, if conditions allow, maybe some spring. I don't know about spring wheat, if that would get planted, but oats in certain areas, not large acreages, but that would take some away from corn. And then or soybeans. I haven't talked with suppliers this week on what they're seeing.
Okay. Anybody else? Last call for questions. Otherwise, like Jack said, feel free to email him or call the office, leave a message, and those are getting routed as well as we go through this work from home situation of 2020.
I would add to that, if guys are thinking personally of switching to soybeans, they'll probably want to be pricing some, because that may be a nationwide thing. And if we see a large shift into soybeans, that price won't look so good in fall. So they may want to go ahead and get some protection on extra acres that they plant, or at least do some of those bushels ahead. Okay.
All right. Thank you very much, Jack. With that, we're going to go to our professors from the Ness School of Management or Economics and Management. And Dr. Wang is going to start the conversation a little bit on the economic situation. I will give you control via your car, and you can take over from there.
Yeah, just so you know, I'm in my car and the internet is not very stable. Sometimes I think I don't see everything, I don't hear everything very well. Just bear with me, right? So what I'm going to talk about is the market environment, stock market, and also the bond market, and also draw some conclusions or my personal view from it. Right. Again, I'm from the Ness School of Management and Economics. I'm a professor here as in the finance area. Right. So let's move on. The last 2 months basically are marked by the market turmoil. You see, this is S&P 500 index, those with the bubbles. From February 19, which is the all-time high, to all-time low on March the 23rd. And we saw 4 drawdowns and what we call the circuit breakers. Basically, every time when the market index, broad index is down by 7%, the market halt. And we have the 9th and the 12th and 16th and the 18th. And that's historical, unparalleled, has never been seen before. So we have witnessed some sort of history in the stock market turmoil. And the also equally impressive is the market rebounded very, very quickly from the bottom, which reached 23rd, and is all from peak to trough was 34%. And now Jack actually talked about that. Earlier, as of yesterday, the market from the all-time high to yesterday is down by 17, 18%, right? And also the green line is what we call the fear gauge, and like how much uncertainty, how much fear that the market participant see or feel. That went up to 83%, and that is basically the financial crisis level, right? So that's kind of what we have experienced in the last 2 months. And here are some comparisons, again, sort of like piggyback on Jack's presentation. We have S&P 500 index that was down as of yesterday, 17%. Crude oil is down 62%, very dramatic. The fear gauge is up 178%, actually went even, the high was over 400%, right? The 10-year Treasury notes down by 56% and is around 60 basis points at this moment. Crude oil, corn is down, and the most active one is down 15%. There is another one that is probably not widely circulated, is this corn volatility, which is basically fear in the corn prices or fear in the corn market, is up 57%. I'm going to talk about a little bit more later about this, right? Well, the market has rebounded quite a bit, but the fear is pretty high. This is the graph, what we call volatility term structure. What it says is at this moment, and what you see, you have several lines on there, and the green one was 1 month ago. The blue one was last week, and the red one was just at the beginning of the market turmoil. And the sort of gold and yellowish one, it is yesterday, or you can see this is at the moment the market sensed the fear of 30, 40, around 40%, or what we call fear index, 40%. And you can go all the way to June, July, September, and all the way to the end of the year. The fear is still very high. 30% is very high. Just for your reference, the historical average is around 15, 16. And the pre-crisis, we are talking about low or high single digit or very low double digit numbers, right? So the fear is kind of like going down a little bit, but it's still pretty high. That's the fear index. Something more relevant to producers, like corn volatility, same thing, what we call the volatility term structure, and the market sense the volatilities in the corn market is going to be very high. And you see the white one is the current anticipation of the volatility in September and also December. And those who follow the corn volatility, you know, you see the red one is a pre-crisis level, again, is around, you know, 14, 18, and 20 is pretty high already. Now you see even in December or even beyond, and even to March 2021, and the level is still pretty elevated, right? You see that number is 26.3 in September, 23 for December, and a little over 20 for March 2021, right? So that means your property crop insurance is, because that is tied to the corn volatility, is going to be sort of reflected in this uncertainty in the corn market. And similar story goes to soybean and some other agriculture commodities. All right, so given the backdrop in the stock market and or in general the financial markets, and you saw the Federal Reserve is pumping huge amount of money to tackle what we call the liquidity crisis, right? I'm pretty sure Joe will talk a little bit more about that. And so I'm going to just give you a very brief overview. And so the Fed funds rate was basically cut to close to zero. And there are some measures, especially what we call the unlimited QE. So basically, there's no limit how much Fed is willing to provide the liquidity to the market. And you saw the market rebounded very, very quickly. And that's from the Federal Reserve. And then on the fiscal side, and the federal government is also trying to save the Main Street from a solvency crisis, right? So we're turning potentially from a liquidity crisis into a solvency or more fundamental economic crisis. We had this CARES Act, and I thought we covered that in the previous webinar, and that was $2.2 trillion, and the kind of flagship program was this PPP, Paycheck Protection Program. Is $350 billion managed by SBA for small businesses. And also related is the Federal Reserve actually willing to support those loans, $203 trillion of loans that is related to this CARES Act, right? I'm not going into the details of that, but this is basically the government is trying to help any way possible. And some basic ideas from the CARES Act, this PPP program, Paycheck Protection Program, that is about $350 billion, actually run out yesterday. and Congress is thinking of some new program to help further. And also probably some of you folks have already received this individual payment. That is $1,200 per taxpayer and $500 per child. And also there are business stabilization programs that is intended for usually larger corporations and for airlines and some other bigger corporations, right? So that's the kind of market environment and how the government is helping. So this is my my own sort of economic outlook, and it's not like serious. It's not based on serious research, but just gave you some idea what I think. Well, reopening that we know President Trump announced yesterday, the country will reopen probably pretty soon, and this decision will be made by states. I think that is pretty much sure, but the situation probably is not as good because majority of economists have forecasted recession is pretty much is a certainty. That's I tend to agree with that assessment, right? Even if we get back and if we reopen and we can anticipate the social distancing probably is going to stay one way or another. And so I think the whole recovery process is going to be long drawn out process. And there may be a lot of implications for producers and businesses and also us for in the academia, right? And this is more or less a consensus. The vaccines is about 12 to 18 months away. And if it's successful and if there is no mutations in the virus, and so there is quite a bit of uncertainty there, right? I think the narratives of deglobalizations and also rebuilding the critical supply chain is going to be almost a sure thing. And that has implications for producers and or exports-oriented businesses, right? So that's kind of a quick economic outlook. More specifically for individuals and the corporations and the business and the farmers, I'm going to very briefly talk about the financial management side or corporate finance side of it. Basically, given this macro environment, I think liquidity and the cash and the credit management is very, very important. So that's why we say that probably the cash is king in this environment. You may need to think of different credit facilities, either revolving credit, line of credit, or term loans, or for corporations, bond issuance and equity financing may be possible. I'm going to go over some quick examples and to give you a sense like what the big corporations have been doing in the moment. Also, you probably need to think of expense reductions. I saw a lot of examples in the businesses and that I know of. There is salary reductions and taking the PTOs and furloughs and layoffs, and those are in the plan and all have been implemented to some extent. You need to think even longer term in the capital expenditure. Do you still want to maintain the same level of capital expenditure to, to think of flexibilities, right? From the personal investment or personal finance perspective, I think long term, we are going to get back to normal. And this is a good opportunity. And at least in the past month or so was a decent long-term investment opportunity. I think we should, and myself too, think of investing when there is a big drop. Gradually, you don't need to put everything in one shot. And so, but at the same time, you want to keep a decent amount of cash on the side just to give you some optionality going forward, right? I mentioned, I'm going to talk about quickly about some of those big names in terms of how the corporate managing the credits. The example of Delta Airlines and all other airlines have been going through the same thing. Delta Airlines, the stock year-to-date return was 61% as of yesterday. And based on their CEO's projection, they need $50 million of cash every day. Their airlines are 90% grounded. So what they did in the past month, they have been pretty much trying to find any way possible to raise funds, right? So they issued equipment notes, basically is using the airlines as collaterals, $1 billion, and basically, and also they have a salary card for all the officers and CEOs and board members, and issued some term loans and credits, drawn some credits, and the total they have $12 billion raised. So that is going to be good for them to run for, probably half a year, a little over half a year. So that's what they have been doing. And the other one is the Carnival Cruise Lines, and it's down almost 80%. The stock price, and what they have been, because they don't anticipate to receive the funding from the government, and what they have been doing is basically issuing bonds and issuing stocks, right? You heard of Saudi invested in about $500 million in the equity offerings of Carnivals. And the company also issued lately a lot of debts and also convertible loans, right? So that's what I have basically. The market environment is still pretty uncertain, and we need to, both the businesses and individuals, need to be flexible and thinking of their credit management. All right, if you have any questions, please feel free to ask.
Okay, so now's your chance. If you have a question for Gerald, you can type them into the chat or unmute your microphone if you want. Well, I think with that, we're going to say thank you for your time and willingness to find an internet connection to join us this morning. And we will move forward with the presentations here today.
All right, thank you.
Thanks, Gerald.
Thank you.
Okay, Joe, we're going to turn it over to you at this time.
Okay. All right. Good morning, everybody. Heather, is my screen visible?
It is. Thank you.
Okay, great. Well, that was fantastic, Zhiguang, and I think what I have here will dovetail reasonably nicely with that. The title of my very brief talk this morning is "Some Trouble Ahead." Of course, it's a play on words. I'm going to start with something we refer to in macroeconomics as a SOM rule. And SOM is Claudia Sahm. She is now at the Washington Center for Equitable Growth, but she was a member of the research team at the Federal Reserve Board of Governors from some time. And what Claudia proposed quite persuasively is a very simple, disarmingly simple indicator of whether a recession is off in the near future. And so what I've graphed here is her rule, which I've calculated. And it's a very simple rule based on the unemployment rate. So without getting into much detail, though the detail is pretty straightforward, it's essentially looking at where the unemployment rate is in, say, the current quarter versus where it has been over the last year. and whether or not the current quarter jumps enough beyond 0.5% or not. And what Claudia determined was that when the current unemployment rate jumps enough, let's just say enough for now, a recession looms in the near future. So I wanted to try to quantify this a little bit rather than just saying, as I think is correct to say, that a recession is on the way, give you some sense of what the empirical sort of reduced form correlation suggests, right? So when you look at this picture, what I've done is I've got the rule, and then I have these so-called recession bars. So you can just see them there, right? A bunch of them. And that's just an indication that during that time, the US economy suffered a contraction or a recession. And so what you notice is every time the blue line spikes, a gray bar is in the vicinity, shall we say, right? And Claudia defines the threshold in particular as 0.5%. So that's why I've put that little bar there as a visual aid. So here we are, we've got the SOM rule very predictably indicating with almost no false positives since the Second World War, when a recession would strike based on this relationship between the current unemployment and the past unemployment rate. So what I thought I would do in my very short time is essentially come up with the latest data point, which we don't have, right? And the reason we don't have the latest data point is because the latest data point is based on the latest unemployment rate, which we also don't have, right? So the little exercise will amount to the following. We're going to take a look at the US labor market. We're going to guess in a rather informed way what the unemployment rate for April, the month we currently are in, what the unemployment rate for April is likely to be, feed it back into this rule and get one more data point and see where that data point is, if it breaks the 0.5 threshold or not, right? And we'll use that as a more sort of empirically justified argument for whether or not the economy is headed into recession, all right? And I should say, please, I know it feels awkward to do. I teach a lot on Zoom, but at any moment, if you have a question or a comment, unmute your mic and just barge ahead and make the comment. It will feel intrusive, but that's Zoom. Go ahead and interrupt, okay? So let's take a look at the labor market. So here's the US unemployment rate, and you can see there's a little bit of indication that the unemployment rate is rising. That's based on the March unemployment rate, which, if you're keeping track, was a very modest 4.4%, but the month before it was 3.5. So that's a 0.9% jump in the unemployment rate. Moderately terrifying, and certainly indicating a deterioration in the labor market at a rather quick pace. But that's all we know right now. And the SOM rule I just showed you knew about that data point, right? That I had a little red check mark above. But that's what we're looking back at right now, if we go back to March. We also see something else about the unemployment rate, and that is, in general, that unemployment rates do this. They go up very quickly, and then they come down and take their sweet time, right, to do so. Which means once the labor market deteriorates in this way and individuals are separated from the job market, as economists like to say, they really have a difficult time reattaching themselves to the job market. So just keep that additional feature of unemployment in mind. Unemployment rates tend to spike, and then they tend to come back rather gradually. And I want to show you this is not just true at the national level for the macroeconomy. We can see this as well, let's say, for South Dakota. So here we don't have so much a very high unemployment rate yet, so I don't want you to call attention to that area, so I'm going to get rid of that red circle. But notice the pattern again. The jump, this happened to be during the Great Recession, and then the rate coming down very gradually, in this case about 6 years before the labor market in our state fully repaired itself, right? Okay. So now let's try to look into a crystal ball and get a sense as to what the unemployment rate is likely to be going forward, right? And again, we'll feed that into the SOM index and we'll see what Claudia's metric has to say about where the economy is headed. So brace yourself. These are initial claims for unemployment benefits. It looks like one data point. It's actually 3 or 4 weeks, the most recent 3 or 4 weeks. What I want you to notice is this is what bad looked like. That's during the Great Recession. And also just to get a sense of magnitude, look at that data point, right? Turn left, look over here. You got a number like 600 or 700,000 claims in a single week during what we identified as the worst of times. This adds up to something like 22 million claims, an order of magnitude larger, over the course of just a few weeks. So the individual weeks, the numbers all blur, I know, but it was like 5 million, then 7 million, then 6 million, then 5 million or whatever, right? But over the course of a span of 3 or 4 weeks, initial claims for unemployment benefits skyrocketed. So the reason this is interesting is, one, it's just fascinating. And as Jiguang said during his presentation, it's historically unprecedented, this rapid deterioration of the labor market. We also have to reason that when the Bureau of Labor Statistics calls these people in a random sample and says, "Are you employed?" they're going to say no. So this is going to give us some indication of what the unemployment rate is likely to look like in April and March, right? These initial claims are not unique to the macroeconomy. It's not just a general feature of the macroeconomy. Here they are for South Dakota. Now, of course, the scale is smaller simply because the size of the labor force is smaller. But you notice it's not seasonally adjusted. So there's nothing to read into all the spikes. Those are just monthly seasonal fluctuations. But that's the level. And then that's the level, right? It's pretty obvious what's going on in the picture. So again, we see this initial claims for unemployment benefits skyrocketing at the national level, as I like to say, from 50,000 feet, viewing the economy as a whole. But this is very much an indiscriminate macroeconomic shock. It is broad-based, and it's inflicting itself on the economy as a whole, and our state's economy and labor market in particular is no exception. Okay, one other measure of claims, equally terrifying, forgive me. But we can look at initial claims, and that's what we've been doing. These folks were never in, if you will, the unemployment benefit rolls, and then they suddenly appeared in those rolls. So you have those folks representing a deterioration of labor market. But you also have people who have already claimed unemployment benefits, and maybe many of them would have gone off those unemployment benefits and back into the labor force, or maybe not. And for that, we're looking at continued claims in unemployment. So let me show you that just for the United States very briefly. So again, these are continued claims. So, at that moment in time, right before it all broke loose, these folks were collecting unemployment benefits. But as you notice in those data, these folks leave the unemployment benefits rolls, if you will, and then other folks, claim initially, and there's just this natural churn. What you're seeing here in the spike, these are folks extending their stay in an unemployed, or what we call an insured unemployed state, right? So again, this number is enormous. And again, going back to the BLS survey, when the BLS surveys those 60,000 households, probably this week, it's in the middle of every month, I'm guessing these folks are going to answer, yes, I'm actively seeking work but unable to find work, and the BLS is going to count them as unemployed as well, right? So we can use these numbers. Again, this isn't a deeply scientific process that I've engaged in, but we can use these numbers in a sort of back of the envelope way, making the assumption that all else remains equal. So there aren't a whole bunch of people in the labor force who suddenly found jobs that we're not tracking and that sort of thing, right? So holding all of that sort of churn equal, we can think about these claims. So what I've done now is I've just listed the initial claims right here as we go down that column. And you can see the horror story starts right about there, right? I'm listing that. And then what I'm also incorporating into the table is just the measure of the United States labor force. So what have I done? Nothing terribly mind-boggling, I assure you. Here's what I'm doing. I'm going to now say, well, look, suppose these folks claimed unemployment benefits, and this was the labor force. So all else equal, because 282,000 people claimed unemployment benefits, the unemployment rate would go up from where it currently is, 4.4%, by that. And it's not very interesting because that's such a small increase, right? And then I did the same thing for all the others. So again, if those are claims and that's the labor force, that's how much the unemployment rate would go up from where it is. Again, it's a marginal effect, right? And on down. And you can see what's happening. Once we hit March 21st, and really the end of that reference period when the BLS was calling people and asking them if they were unemployed, so we could safely assume that these folks were not called in March, you get what I've now indicated in red. And so very back of the envelope, if you add these up, and I'm just going to do the 2 plus 4 plus 4 plus 3 part because Mike can't handle the arithmetic of the rest of it, right? So that's 610, just these numbers here. We have, something, let's just call it about 15% increase in the unemployment rate, right? So that would be horrible if that were the unemployment rate. That's the marginal effect. We're assuming all else has remained equal. 4.4 would have been the unemployment rate had red not happened. Red did happen, so we had 4.4 on top of 15, and I won't even do the math because it's too scary, right? But the point is that the unemployment rate for April, and then because unemployment rates tend to persist in the way I showed you, you get the spike and then you get the very gradual decline from the spike, the unemployment rate is likely to rise to something on the order of between 10 and 20%. And it's likely to stay there for a while because once individuals are detached from the labor force, there's a very messy search process that's required to reacquaint them or reattach them to the labor force. And if you add to this innovation and AI and all sorts of labor-saving technologies, that process can really take a long time, where firms who might have accepted this labor a month ago have now gone on, engaged in the sort of capital expenditures that Jiguang mentioned, and perhaps no longer have the need for labor, and so on and so forth. So that process will lead to an unemployment rate that takes a very long time to come back down. This is incidentally why things like a payroll protection program, again, that Professor Wong mentioned, is to macroeconomists a very interesting policy instrument, because the best way to keep a job is not to destroy the job. And so even if these individuals are simply being paid, essentially you're taking out a loan to underwrite payroll, at least then when it comes time to reinvigorate the economy, you simply call them back, right? And that's why macroeconomists tend to favor that sort of policy. Okay, last bit. If we take that number, I'm going to call it a total 15% unemployment rate for April. And remember the objective here, we're going to feed it back into the SOM rule, and we're going to get one more data point. And so there it is. So the actual data stop right there, right? And then what's the extension of the blue line? That's what this SOM indicator would register if in April, the unemployment rate is 15%. That's the number I fed into the algorithm, and it goes up to 4. What's important about 4? It's higher than 0.5, which is the threshold, indicating a gray bar is on its way, right? That a recession is going to follow this enormous spike in unemployment. And by the way, the relationship between these two variables, employment and output, is one that macroeconomists have known for a long time. Some of you may have heard the term Oken's law. Oken is Arthur Oken, who proposed this idea that there was a very, very reliably strong relationship between the unemployment rate and output. And that's really what we're exploiting here as well. The bottom line is, historically speaking, we've never seen a spike in unemployment of the order that we expect to see now, and then not have a severe contraction in macroeconomic activity. And so we have no reason to suspect that the US economy is simply going to move along as if this unemployment deterioration or this deterioration in the labor market had never happened, okay? And then finally, Heather asked me if I would just promote a little something. This is something that we do at the Nest School. It's called Morning Macro. It's on South Dakota Public Radio most Mondays. It alternates throughout the year. But in any case, if you punch that in, school.blog.com, the first dot is literally DOT, not a dot. You'll get a website which has all of the blog posts that I've prepared in relation to the various radio programs that deal with all of these sorts of topics we're talking about today, that is on the macro and financial economic side. And it also has a link to each radio program, so you can get some podcasts and so on. Okay, that's all I have. Thank you for your time, everyone.
Okay, any questions for Dr. Santos?
And feel free to unmute your mic.
Yeah, you can ask them straight out if you would like.
You can just shout.
Oh, there's one in the chat.
Okay. Is there anything this situation that would make the recession deeper or not as deep as the other gray bars? Well, that's a really good question. So this gets to this idea of whether what we have coming, we know it's a recession, right? We've established that, unfortunately. Is it V-shaped or is it U-shaped? And initially the thinking was it was V-shaped, because the thinking was that what we were doing was shutting down the economy in a way that one shuts the light. And then if we simply, if you will, flick the switch, we would get the economy going again. I think that was always a bit of a simplistic, superficial way of thinking about things. I don't blame folks for thinking about things that way initially, but I think that has proven itself to be superficial. The SOM index and these relationships between unemployment and output don't have much to say about duration of the recession. And so for there, we have to look more broadly at other economic indicators. I find it very difficult to imagine a V-shaped recession with an expansion that begins almost as soon as this second quarter we are now in is over, and then the economy begins to grow very quickly and unemployment begins to fall very quickly. If any of those two happen, my sense is output will likely grow more quickly than unemployment returns back to its full employment levels. But in any case, I don't think either of those two variables will respond in an expansionary way as quickly as we once thought. And so I think U-shape economic, if not recession, underwhelming growth is likely something that we're going to see throughout 2020. And again, I think Dr. Wong very nicely demonstrated that with the market's fear indexes and those sort of yield curves on volatility, demonstrating that even if you go out to 2021, there's not a lot of evidence that the market is, if you will, pricing in a placid macroeconomic environment. On the contrary, they seem to be sort of anxious, and that anxiety seems to be priced in for much more than just this quarter or the next quarter. So I think U-shaped, not V-shaped. That's a great question.
Anybody else? Okay, I think with that, we will say thanks, Joe. We greatly appreciate your participation. And we'll probably try to bring you back again as this thing keeps continuing here, so.
Oh, well, thank you for the invitation. And I was going to say hi to Mike Doomer, who I see out there in the audience. It's good to see you, Mike. Thanks, everyone.
Okay. With that, we've got just a short period of time left, and I am going to very quickly show you one of the newer tools that's available from Sdsu Extension. This is called, if you look at the top corner there, the Sdsu Net Income Application. And Doctors Lisa Elliott and Matt Elliott created this to help us with some of our grain marketing decisions and some of those types of topics. So as always, when we talk about grain marketing, we need to know what our inputs are so that we can determine what break even comes to. The numbers that are currently listed in here, our Jack Davis filled out for us based on the budgets that are listed on the Sdsu Extension webpage. So we start with those. We pick our region over here in the corner. So whichever region of the state you are from, you can choose your region. and also the commodity that you would like to look at net income of your production throughout the year. And then you also get to change your contract month based on a normal selling season for that commodity. And for this example, as we go through it kind of fast, we're going to use East Central corn using the December 2020 futures market there. So if we leave all of the inputs the way they are, one thing I want you to notice as we start looking at income is that currently there's no rent listed. So if you are paying cash rent for a piece of ground, or you want to include your cost of insurance or taxes on a per acre basis, those would be inputted here as well. So this is the input tab. If we go to the futures and price or basis tab, this is what the current futures are for December 2020 corn. And you can see we've had kind of a fall off in the situation there. Other components that you can look at on this tab are the historical basis maps and the historical basis charts. Those will open up for you in different internet tabs. So I have them open here. Here's the corn spot basis for East Central South Dakota. The blue line is the basis number. So you can kind of see some seasonality and some changes there as you would go forward. And if you scroll down, the months are listed at the bottom. The other lines are different export markets and what their basis levels are in those markets. And the third tab there, here's your corn spot basis map. If we're looking at corn and it's all color coded, you can zoom in or out and find the town nearest you so that you can see what the basis level is in those areas and make some marketing determinations there if you can gain 20, 30 cents by hauling 10, 15, 20 more miles. So just due to the time that it takes to open each of those tabs, I have them open ahead of time. But you can find them by clicking either one of these links over on the side. The other thing I wanted to share on here, we have our trend yields, and this is going to be what the income is based off of. This comes from USDA NASS average reported yields for the different years. So here's our 2012 yield when we were dealing with a drought, and some nice years in the East Central region of a 184 average in 2016. If you believe that your corn average is higher than this expected 175, you can make those adjustments on the adjustment range over here. That indicates that your anticipated yield has a higher likelihood of being better than average, and thus we use it in the calculation that direction. So we just keep everything uniform here. Then the final tab, and the one that gives us what our expected net income is, opens up first when you start looking at things. And you can see there was a period of time where we were looking at net income in that touching $180 to $120 an acre range as we kind of move through until we hit March. Keep in mind that there was not any rental rates added to the expenses for this example. So as you look, then you can kind of see where we're at currently, and given those prices for corn, just over $40 of income on a per acre basis, giving the input costs that we indicated and the yield range where we had put our yield in at that point. This graph takes it one step further and lets you look at how many days the yield or the income has been at different levels. The green bars indicate the last 5 trading days. So in the last 5 trading days, twice the income level has been from $40 to $49, once in that $50 to $59 and twice in that $60 to $69 range. And then here it shows that for 54 days, it was at $150 to $160 range. So this is just one of those other tools that are available to you. And we wanted to kind of showcase them a little bit. It's kind of fast, kind of wicked and dirty there that we presented today. But I think once you start putting some of your numbers in, this will help you with some of your marketing decisions and ideas that way as you go forward. So if you want, you can write this agland.sdstate.edu/net_income/. That's where you're going to find it at. You can also do a search on the SDSU extension webpage for, if you type income into the search bar, it'll get you to an article that links directly to this. So if I unshare here, and then if there's any questions or comments that you have, that would be great at this time. Otherwise, we will try to wrap up today's presentations and go from there. Jack did list that webpage if anybody just wants to copy and paste that out of the chat bar. With Zoom's new updates, the links are not live in the chat bar anymore due to some security issues and changes that they've made. So I believe you can copy and paste that and go from there though.
Yeah, we'll pick up off the recording.
Right.
And we could put a link maybe in the presentation somewhere that we send out, or I could put a link in mine or send them to that article. We can do something like that.
Correct. So all of our presenters are still available. If you had a question come up related to any of the topics, feel free to unmute yourself or type them into the chat bar.
I have a question, I guess, probably for the audience. Are we going to see a shift to soybeans? Same question back to them. I don't know that I'll get any answers, but I'm just asking.
I don't see any responses. Okay, so with that, I think we'll wrap up for the day. If you do have questions that come up or anything in that manner, we want to make sure that we're keeping these dialogues important and fresh for you. We want to make sure that we're covering the current situations you're dealing with and that you're seeing out in your farming operations or with the clientele you work with. So if there's a production cost component that we need to cover, if there's a marketing situation or a new tool or something like that that you've heard about, please let us know. We'd be more than happy to try to turn that into part of our dialogues. This week, we also hosted a CARES Act webinar. So if you are interested in watching that, it is available on the SDSU Extension YouTube channel. So if you do a search in YouTube for us, you should be able to find us there. Additionally, I hope you can see my contact information on your screen. There's how to get a hold of me. Send me an email. We'll get your questions answered or your topic ideas evaluated. Also, my Facebook handle is listed there. If you like me on Facebook, you'll have the ability to get direct links to the presentations that just wrapped up and other topics and articles that would be pertinent for you. So there will be an email coming with this recorded session in it, probably within the next week. It takes a little while to get things all edited and the captions put together, but we'll get her out as fast as we can. And also you'll probably be getting an invitation for the May 15th Ag Dialogues. So we do have number 12 planned, and we will do that on May 15th at 10 o'clock. With that, last call for questions. And Mike did answer your question, and he says he'll have a better answer for you next week on that.
Yep,
change
I
in
saw that.
consumer
Thank
soybean.
you.
So with that, thank you to our presenters today. Thank you for those of you that were able to join us. We appreciate your time and attention throughout the presentations, and we'll see you again in May.